Hello, this is Rich Vessel, founder of Advanced Projections, here with our March 30th, 2023 edition of News versus Noise. So, of course, we want to cover what's been in the financial noise over the past several months, especially in this first quarter of 2023. People have been saying in the popular media, of course, it's part of the noise. Inflation, the worst may be behind us. We're saying not yet. Unemployment has stayed near record lows, currently at 3.6%, which is still lower than previously expected, but the real news is what this is telling us to look forward to for the next steps for Federal Reserve monetary policy. Energy prices have come back down quite significantly. Gasoline and natural gas prices especially. Now the question is, which way will they go this spring and summer? Last year, middle of the year, stock markets entered bear territory, but have since rallied inside their downtrends, and the S&P is currently about 10% above where it bottomed out back in last October. The real news, which we'll cover in a minute, is what's likely to come next and why. Financial advisors are still saying, for the most part, stay the course, buy the dips. And our news is it's still a bad idea. Everybody is questioning, are we in a recession? Are we headed for one? Most of the sources, including the Federal Reserve and the administration, are soft pedaling the chances of an actual recession. We respectfully will disagree. So, here in the real news for the first quarter of this year, labor shortages persist and residual supply chain issues are slowly declining. So things are loosening up a little bit. However, the latest employment reports shows that employment is still expanding. Unemployment remains well under 4% at 3.6, and low unemployment gives the Fed the green light for further rate hikes as tight labor markets make it impossible to drive inflation down to 2%. Oil prices cracked with the Fed's continuing rate hikes. Action in energy prices, if it continues, will reflect concerns about upcoming recession and retreating demand for oil, but offshore production cuts will try to support prices. Now, as of this publication date, oil is down about 40% from the second quarter price peak of $123 for the West Texas Intermediate crude. Natural gas prices have declined quite a bit, but are still well above what they were a year ago. OPEC and Russia, a few months ago, renewed the 2-year-long production cuts that were in effect up through April of last year, and it may try to stabilize oil in the $65 to $80 region for several months. Further production cuts may be coming as global demand softens. Domestically, you can expect gasoline prices to most likely move north of $4 again for the short term, as a large number of refinery maintenance shutdowns are expected to occur this spring, March through May, which will also push up on the headline CPI numbers. Now, here's the main things that you should be paying attention to. The Federal Reserve has continued to uphold their reasons for proceeding with their clearly scripted plan, while emphasizing their awareness of the economic pains to come from high and still rising rates. They're going to continue to unwind their balance sheet, which seems to have been accelerated in the last couple of months. They're going to raise interest rates more during 2023 and perhaps into 2024. Very unlikely to reverse or pause until late next year or into 2025. Now, the Federal Reserve Open Market Committee's turning point. Full employment means unemployment at or below 4%, with the last low set pre-pandemic at 3.5% in late 2019. The last 7 unemployment reports have been at or below 3.7%. The latest, this last month, is at 3.6%. January and March FOMC meetings each contain a new rate increase and affirmation of their solid guidance about ongoing steps to manage inflation and the health of the economy, as we had been predicting all along during 2022 and again early this year. Every open market committee meeting since March of 2022 has confirmed this stance and has included aggressive rate increases. The M2 money supply is shrinking as the Fed unwinds its balance sheet, which pulls liquidity out of the markets. The M2 is down 4% over the last year, and our target is approximately a 10% total decline. Now, Advanced Projections believes the Fed will monitor effects of foreign adventurism by Russia, but will continue to proceed firmly and aggressively to rein in inflation over the next 18 months, even in the face of mounting criticism from the public and politicians. And one other thing, which of course just showed up a couple of weeks ago, is that there are new financial system stresses which have appeared. Several smaller regional banks subject to less regulation since 2018 have been significantly harmed by rapidly rising rates and terrible management. That's the thing we didn't write here. But their management basically ignored the trends in bond prices, and that basically just clobbered their balance sheets. Now, one domestic and one international failure have already occurred. Silicon Valley Bank and Credit Suisse. Both have been rescued through government intervention, followed by absorption by larger competitive banks. More such failures can occur. A few would be tolerable, but more than a few indicates serious risk issues with banks overall and could cause the Fed to temporarily halt their rate increase script. So we have to keep an eye on any additional failures which start to pop up. The equity market super bubble collapse had already begun back in the first quarter of last year. High employment combined with high interest rates will push us into recession relatively soon, anywhere from right now to perhaps 9 months ahead. The start of the equity collapse preceded the onset of this recession, just as we had predicted almost a year ago. Now, all 6 of our indicators have been hovering in or near red for several months, meaning it's a 90+% probability that we're in recession now or soon will be. And we have concurrence from indicators used by the Federal Reserve and the Conference Board about the top quality information that you can get out there aside from our own. So here's what our 6 indicators have been doing over the past year. We have our precious metal indicator, our stock index indicator, yield curve indicator, the Federal Reserve indicators, the money supply indicator, and the leading economic index indicators. And all of those in the past year have moved into strong recession indication. And with this kind of level down here, we're looking at a 90+% recession probability. Now, why do we say other sources confirm what we're saying? All right, so the Cleveland Federal Reserve has a calculation that is based on the rate of change of the same spread we watch in the yield curve, which is the 3-month versus 10-year interest rate spread. And when that spread goes negative, in other words, 3 months pays a higher rate than the 10-year instrument, that is an inversion. And the rate of change in that inversion is what the Fed uses to determine if a recession is going to happen or not. And you see here, they assign a probability based on that. And we say, okay, if their probability hits 40%, recession is pretty much guaranteed. Sometimes it doesn't reach 40% and a recession occurs. But in this case, here's where we're at now, over 63%. And it's been there for a couple of months already. So this is the window. If you look at past history, this is the window in which the onset of a recession should occur, which is right where we're at now. The other organization, financial statistics organization, is the Conference Board, otherwise known as TCB. And their leading economic indicator basket points at an imminent recession also. They went into a warning for 1 month a few months ago and immediately dropped down to a recession signal several months back. So here we are with their latest data out from February, and we're looking at a strong recession indication from their standpoint. Now, these little reversals here are inconsequential. You'll see here during the Great Recession, there was a little reversal, and you see a couple of reversals on the way into the super bubble .com recession. So these little doohickeys here, you can pretty safely ignore because as you'll see, as the recession becomes more pronounced, these trends will continue downward. And we're looking for something in the leading indicators to end up down in this area during this year or early next year. So in terms of the stock markets, equities continue to be overvalued in the aggregate. Fourth quarter earnings from last year and the first quarter of this year earnings downgrades show that cracks are forming in the equities markets walls. And we're seeing, of course, increased volatility, greater swings in price due to the believers and the non-believers about recession versus recovery. And that's very typical of what happens before the markets crack and take a nice dive down, as recession begins to occur. Now, I say nice because it's nice for us who are sitting in cash, which is where we should be, while we wait for rational pricing to be restored in the equities markets. The misconception right now, especially amongst the younger investors who haven't experienced any crashes, is that the new equities markets declines won't go much deeper or be very prolonged. So just hang in there and keep playing the markets. And we, again, disagree with that approach. Now, there's a cycle of stock market investor emotions. This is typical of, many aspects of human behavior. But basically, as people become more and more confident and enthusiastic about, in particular, this scheme to, be able to make money in the stock markets, when you recognize euphoria, that's the time to get out. And the euphoria occurred at the end of 2021. Right at the beginning of 2021, the peaks were set in, or beginning of 2022, peaks were set in the markets and they started to decline. So getting out, the people that are still remaining begin to experience worry and concern. Then they start to get a little nervous. And if, things don't turn back on them, all of a sudden it becomes alarm, dread, gloom, and capitulation and depression, which is what we expect from this super bubble collapse sometime in late 2023 or by the middle of 2024. This is the time to get back into the markets. But right now, we're in cash, and that's what we recommend people to be in. There's ways to make the Fed funds rate, which is about 4.5% on that cash. And, you're preserving your capital, which is the number one goal of investing. So, as we said, the euphoria was over a year ago, the super bubble created by the massive federal economic COVID interventions will continue to deflate over many more months, perhaps longer. Rising rates, energy prices, and foreign adventurism will create the necessary fear and uncertainty. It has already reached 2022 lows in excess of minus 25% and should inevitably cycle through the full range of bear market emotions which again finally end in capitulation at the bottom. Here's a nice comment by one of our long-term subscribers, and he's quite satisfied with what we've been doing for him in terms of having a concise and concentrated source of economic information. Thank you for watching this video. If you like our content and feel it's valuable to you, please consider giving this video a thumbs up and subscribe to our AP Newsroom YouTube channel. You can get limited time free access to our full member reports via the first link in the description below. And please, you would benefit from joining our free economy monitoring group on Facebook, where there's a link also provided in the description below. Leave us a comment with your thoughts and questions. Thanks again. We'll talk to you soon.